Chapter 8, 1995 to 1999. Introduction. The 1995 to 2004 decade was marked by compounding growth. Not only did the headline figures such as revenues, earnings, and shareholders' equity expand, but the sheer number of acquisitions increased noticeably. Berkshire's 1996 acquisition of the second half of Geico and the 1998 acquisition of General Reinsurance supercharged its insurance operations. These two acquisitions were the final two cornerstones of the insurance group, which would see average float balloon to over $45 billion during the decade. Insurance was certainly a dominating force at Berkshire, but its many non-insurance acquisitions further diversified its earning streams. A number of these new acquisitions, such as within the jewelry and furniture retailing segments, resulted from existing industry relationships Berkshire subsidiaries had with non-competitor peers. Some acquisition opportunities manifested suddenly after past troubles caused a need for new ownership. Other times, acquisitions occurred after financial buyers, such as private equity groups only interested in short-term profits, caused the business to falter and which were revitalized under Berkshire's protective umbrella and conservative financing. Some acquisitions during this period, most notably Mid-American and Mytech, came with additional outlets for cash after they made their own acquisitions. All these acquisitions added to the family tree that was Berkshire, but did not alter the overall structure of the company. The Berkshire Hathaway that ended the decade like the one that began was a conglomerate with many diverse businesses. At the end of the decade, it was just a larger and more rounded-out conglomerate. Insurance was the main engine, followed by its wholly owned businesses and important long-term investments in marketable securities. In order to comply with SEC regulations, Berkshire increased its directorship with 5 new members to its board of directors. In some ways, Berkshire's size finally began catching up with it. Interest rates continued to decline during this period, making idle cash that much more painful to hold and driving up valuations in controlled businesses and marketable securities. The dot-com boom that started in the mid-1990s and continued into the first years of the new millennium did have one silver lining. While others were busy bidding up businesses with no cash flow or long-term prospects, Berkshire picked up numerous old-line businesses with long histories of producing cash. Yet even with these acquisitions, Berkshire ended the decade with over $40 billion of cash and no immediate place to put it to profitable use. 1995. The year 1995 represented the start of Buffett's 4th decade at the helm of Berkshire Hathaway. Oftentimes, executives think about retiring or at least reducing their workload. Buffett reached the typical retirement age of 65 that August, and Munger was already 71, so it was a fair question whether Berkshire's 2 capital allocators would soon slow down. While both were outwardly showing some signs of age, their minds were not. If anything, they were getting better. As Charlie Munger would say at the annual meeting in 1996, Buffett, though this also applied to Munger himself, was a learning machine. Berkshire would benefit enormously by having top managers without any preconceived notions of retirement, allowing their knowledge to compound, just like the capital under their control. Defying Buffett's predictions, again, that Berkshire's size would be an anchor to future returns, headline figures for 1995 showed an enormous increase in net worth. After adjusting for shares issued in connection with 2 acquisitions, per-share book value increased an eye-popping 43.1%, compared to the S&P's increase of 37.6%. More exciting were 3 acquisitions that doubled Berkshire's revenue and significantly added to its long-term earning power. During 1995, Berkshire acquired 2 non-insurance companies, Helzberg Diamond Shops and R.C. Willey Home Furnishings, using Berkshire shares, and half of an insurance company, Geico, of which it already owned 51%, using cash. The Geico acquisition technically closed January 2, 1996, so 1995 was filled with discussions about the upcoming event. Helzberg Diamonds. The Helzberg acquisition closed on April 30, 1995. Founded in Kansas City, Missouri, Helzberg grew from one location in 1915 to 134 stores in 23 states by the mid-1990s. In 1994, the company had $282 million of revenues, which was an almost 30-fold increase from the $10 million in revenues it had in 1974, proving Buffett's point that the best strategic plan was no plan. The company arrived on Buffett's radar accidentally when Barnett Helzberg, the company's CEO and the grandson of its founder, saw Buffett on a street corner in New York City and approached him. Helzberg was comparable to Borsheim's in that both sold jewelry at rates per square foot far above their competitors, and both had low overhead compared to their competition. But the businesses were different in other respects. For one, Helzberg operated a chain of stores that were predominantly in malls or strip malls. Borsheim's was a one-store location that had over $50 million of inventory, a huge selection that couldn't be replicated over dozens of locations. As Buffett put it, Borsheim's can't be Helzberg's, and Helzberg's can't be Borsheim's, but both were good businesses. It is interesting to note how good returns on capital can be produced in two different ways in the same industry. Helzberg's success stemmed from its rock-bottom operating costs and prime locations in busy shopping malls nationwide. The average Helzberg store had a $2 million of annual sales, far more than its competitors. Helzberg's higher sales also produced lower expense ratios compared to competitors. Helzberg was a quintessential Berkshire Buffett acquisition of a good company with great management. For the selling family, it was a tax-free way to diversify their holdings. R.C. Willey. Berkshire's other 1995 acquisition, also completed via a stock transaction, was R.C. Willey Home Furnishings. The R.C. Willey acquisition came about through Irv Blumkin of Nebraska Furniture Mart. Irv Blumkin, Rose Blumkin's grandson, knew R.C. Willey's CEO, Bill Child, and had spoken to both Child and Buffett about the merits of a partnership. Like the Helzberg family, the Child family wished to diversify and take care of estate planning while continuing to run the family business. Berkshire was a perfect fit. As with Helzberg and Borsheim, some differences existed between R.C. Willey and its sister company, Nebraska Furniture Mart, which Berkshire purchased in 1983. Nebraska Furniture Mart, like Borsheim's, was Omaha-based and operated out of a campus of adjacent buildings. Both R.C. Willey and Nebraska Furniture Mart had similar sales. R.C. Willey had $257 million in revenues in 1995, but unlike Nebraska Furniture Mart, R.C. Willey operated out of 5, soon to be 6, Utah-based locations. Both Nebraska Furniture Mart and R.C. Willey were also retailers, a business Buffett knew to be very difficult. Both were run by managers with long track records of success, a key criterion for Buffett, who told shareholders, "Buying a retailer without good management is like buying the Eiffel Tower without an elevator." Also, just as Nebraska Furniture Mart had a lock on the Omaha market, R.C. Willey had over 50% of the furniture business in Utah. The acquisition was funded by a combination of Berkshire stock and cash. The exact price was not disclosed. Geico. The third and largest acquisition of the year was the second half of Geico, which legally closed on the second day of 1996. Shareholders were very familiar with Geico, which had been on Berkshire's books as a marketable security since 1976. Berkshire's ownership grew from 33% to 51% in that time, owing entirely to Geico's frequent share repurchases. In 1995, the opportunity arose to buy the remaining half of the business. Compared to the $46 million it cost Berkshire to buy the first part of Geico, the $2.3 billion price tag for the remaining portion was enormous. This implied a roughly $4.8 billion valuation for the whole company, or about 2.5 times its year-end 1995 book value of $1.87 billion. The price tag was large, but not exorbitant. Geico had $3 billion of float, and its long history of profitable underwriting meant the float would be profitable and had a high probability of growing. This proved true. At the 1996 annual meeting, a discussion on float and Geico suggested Berkshire got a bargain. Is float better than equity? In response to a question on the intrinsic value of Berkshire's insurance companies, Buffett offered insight into his and Munger's thinking on float. It was and is somewhat counterintuitive, but upon reflection is astoundingly simple and brilliant. Buffett, always one to use extremes to prove a point, posed a rhetorical question. Would I trade that, Berkshire's float, for $7 billion of equity and not have to pay tax on the gain, but then have to stay out of the insurance business forever? His answer was no. We wouldn't even think about it very long. Buffett was saying he would not take a genie in a bottle arrangement to magically transform a $7 billion liability into $7 billion of equity. This should have caused everyone to sit on the edge of their seats. The reason Buffett would not take such a hypothetical arrangement was that he expected the float to grow over time and at an attractive cost. Berkshire's insurance businesses were gems due to one simple fact. An insurance operation is valuable only if its float does not cost it money, or at worst, cost it what it would cost the government to borrow funds, which is cheaper than the cost a corporation would have to pay. Berkshire's insurance businesses were arranged over time and not without some bumps and lessons along the way to deliver cost-free float. Float, a liability to the company, was more akin to equity than it first appeared. If float could grow over time, it would be that much more valuable. This assertion that a liability could be considered equity can be a hard concept to grasp. It helps to think about what pure traditional equity is. Is not the equity owners put or retain in the company a liability due them at some unspecified future date? Does it not come without the requirement to pay interest? Why not then define equity as funds held by a company that have no explicit repayment terms and no explicit cost or interest rate? Following this logic, it stands to reason that the right kind of float can be considered equity, or in some cases better than equity if it generated an underwriting profit over time. Furthermore, such quasi-equity did not dilute shareholders' ownership like a pure equity investment would. Berkshire's float, and especially Geico's, was money owed to policyholders in one form or another, but that, because of its revolving nature, could not be called in its entirety like a loan. In other words, individual policies would be paid daily, but new premiums would be written collectively that could reasonably be expected to maintain the overall level of float. Considering Berkshire had a recent history of writing profitable business and growing float, even under poor pricing conditions, this was an easy argument to make. If we assume that Geico's float would, at worst, break even and not grow, it could appropriately be considered quasi-equity. Adding this quasi-equity to its book equity, we arrive at a purchase multiple of 1 times book value. See Table 6.4. We can also use an earnings approach as a check. This framework results in an initial pre-tax earnings yield that may seem low. Considering this did not account for any expected growth nor any look-through earnings from the investment portfolio, it is worthwhile validation of the $4.7 billion valuation for Geico that Berkshire paid to acquire the rest of the company. Insurance. Underscoring the good year Berkshire had in 1995 was a third straight year of underwriting profit and yet another year of growth in float. All told, Berkshire's insurance operations generated a pre-tax underwriting profit of $21 million, and float increased 18% to $3.6 billion. It is worth highlighting the conservatism embedded in Berkshire's insurance operations, not only on an operating basis, i.e. its unwillingness to accept improperly priced risks, but also on an accounting basis. For more attentive readers, the financial statements contain clues to the margin of safety built into Berkshire's accounting. Berkshire's reported results were better than the headline underwriting gains would suggest due to accounting practices that did not factor in the time value of money. In its structured settlements business and certain reinsurance contracts, payments would be made years or in some cases decades in the future. This meant Berkshire benefited from the use of funds over time. However, the accounting required that all future expected losses, except for structured settlements which were discounted, be booked on an undiscounted basis, that is, up front. It was the economics that mattered most, not the accounting. If any gray area existed, Berkshire would err on the side of conservatism, even if it made results look worse. Conservatism and smoothness are sometimes lumped together, but they shouldn't be. Buffett liked conservatism and was also okay with lumpiness, or uneven results. Berkshire's entrance into the supercat business brought large policies and large, but infrequent, losses. Berkshire at this time was willing to underwrite a $1 billion policy, though it was rejected. The largest policy it wrote was $400 million. Large policies would create volatility, but were also a competitive advantage that led to superior long-term results. Competitors preferred a smoother ride that ensured the safety of their jobs. The reinsurance group wrote and earned higher premiums in 1995, but pricing began to soften as competitors flush with capital looked for business. Unfavorable loss development added $30 million to losses. Accounting charges from deferred charge amortization and discount accretion of structured settlements were also responsible for reinsurance swinging to a loss of $21 million from an underwriting profit of $81 million in 1994. Berkshire's more traditional and less lumpy primary group performed magnificently. National Indemnity wrote to an 84.2% combined ratio. Home state operations turned in an 81.4% ratio, and Central States Indemnity grew volume 23% and underwriting profit by 59%. Buffett had nothing but praise for Ajit Jain, Don Worster, Rod Eldred, Brad Kinsler, and John Kaiser, all of whom Buffett pointed out were under 45 years old. Geico, not yet part of Berkshire, turned in strong results in 1995 that rivaled Berkshire's entire existing insurance operations. Manufacturing, publishing, and retailing. Berkshire's non-insurance operating subsidiaries had a few stumbles during 1995, and Buffett was quick to point them out. "Just tell me the bad news, the good news will take care of itself," was the philosophy Buffett attributed to Munger in what he followed in reporting to shareholders. The shoe business, the Buffalo News, and World Book all had different problems during the year, which led pre-tax earnings for the manufacturing, publishing, and retail businesses to fall 1% to $332 million. Worse, pre-tax return on tangible invested capital fell 11 points to 38% because of higher average capital employed. After-tax return on equity was 26%, down 6%. In the shoe group, comprised of H.H. Brown, Dexter, and Lowell Shoe, pre-tax operating earnings fell 32% to $58.4 million. Buffett told shareholders he thought the problem was cyclical, not secular, and he expected operations would climb back to top-grade earnings in the future. If it was any consolation, Buffett reported that competitors in the industry made only marginal profits or worse. Including the Buffalo News in the troubled category was no surprise to shareholders. Prior reports detailed the long and winding road from losses to profits to current challenges. The paper was still a good business, but it could no longer be considered an economically superior business like some of Berkshire's other gems. Pre-tax earnings declined 14% from the year before as cost pressures weighed on results. These included newsprint costs up 40% in 1 year, employee buyouts, and changes to depreciation schedules. Still, the business was pulling its weight with $47 million in pre-tax earnings, not bad for a business that cost $35 million. World Book was also not a surprise in this group of bad news first companies. Its print encyclopedias continued to struggle against fierce competition from CD-ROMs. Earnings that year plummeted 64% to $8.8 million as the business worked to remain viable in an electronic age, including shifting toward direct distribution channels. If any of the managers at these units were worried, Buffett provided some reassurance to them. "There is not one of them we would replace." Going one step further at the annual meeting, he assured shareholders World Book would not be sold. C's operating profits continued to churn higher even as the growing slate of businesses meant it received less attention. In 1995, revenue at C's grew 8.1% to $234 million as the company pushed into wholesale and mail orders. Long beset by physical volume declines, pounds of candy increased 7.1%. Same-store sales, an important metric indicating demand from individual stores, was not disclosed. Operating profit increased 6% to $50 million, an incredible 21.1% operating profit margin, and a return on tangible equity likely in the triple digits. Together with the results from insurance, Berkshire's consolidated pre-tax operating income declined a little less than 3% in 1995 to $815 million. This was not a bad result, but it wasn't great either. Buffett's comment that there's no reason to do handsprings over 1995's gains is borne out by this operating result. In fact, most of the 43.1% gain in per-share book value was a result of the rising tide of the stock market pushing up the value of Berkshire's investment portfolio, not intrinsic business growth. Convertible preferred stocks. Berkshire's goal with its 5 preferred stock investments was to do better than fixed income securities available elsewhere. On average, it had done reasonably well. The superior performance of the Gillette issue saved the day and balanced out mistakes made with other investments in this class. The 8.25% convertible preferred issue from Gillette had cost Berkshire $600 million. At the end of 1995, it was valued at over $2.5 billion, owing to the performance of the common shares. This was a very good result, yet a more profitable path was possible. Berkshire would have earned $555 million more if it had purchased all common stock instead of the convertible issue. On the negative side of the ledger, the Solomon Preferred came with its infamous and relatively recent episode of management distraction and a serious risk of loss. The biggest mistake, though, was the U.S. Air Preferred. The airline's prospects looked better in 1995 than they did the year before, but Berkshire was not yet out of the woods. An important aspect to the U.S. Air Preferred is worth mention. The security was structured with a cumulative dividend provision. U.S. Air had stopped paying the dividend owing to its operating troubles, but those skipped dividends were still owed to Berkshire and were compounding at a rate of 5% over the prime rate. The company would have to come out of its woes to pay the monies it owed, but at least Berkshire had some protection as a creditor. 1996. Few CEOs would state that they thought it a good thing that their company's stock price changed little during the year, yet this is exactly what Warren Buffett told shareholders in his 1996 chairman's letter. Buffett and Munger wanted Berkshire's share price to closely track its underlying intrinsic value. During 1995, that relationship became unhinged, and Berkshire's stock price got ahead of its underlying intrinsic value. A year later, its intrinsic value increased significantly and caught up with a slower advancing share price. How Berkshire's business results led to that correction is the story of 1996, but first it is worth examining the numbers behind the ratio. Beginning in the prior year's annual report, Buffett began supplying a table they believed would help people trying to estimate Berkshire's intrinsic value. The table showcased the 2-column method of valuing Berkshire. See Table 6.6. It supplied readers with historical data on investments per share and pre-tax earnings per share, excluding all investment income. We can make some reasonable assumptions with that data to come up with an estimate of Berkshire's intrinsic value and, perhaps more important for this exercise, view the change in the price-value relationship. The logical investment framework behind the 2-column method is that Berkshire's value stems from its investment portfolio and a capitalized multiple of its operating earnings. It is important to note that especially as it pertains to investments per share, Berkshire's capital structure was conservatively financed. Investments per share could have easily been funded via debt, yet at both year-end 1995 and 1996, Berkshire's borrowings amounted to under 10% of equity capital. Its assets were funded by float, but float was growing and profitable. It was therefore appropriate to ascribe investments per share to value per share. At year-end 1996, investments per share totaled $28,500, compared to $22,088 at year-end 1995. The assumptions behind the capitalized value of operating earnings also deserve some careful thought. Since all assets are in some way tied to the opportunity cost of risk-free investments, it is appropriate to look to the long-term U.S. Treasury rate, in this case the 30-year bond, for comparison. Between year 1995 and 1996, this benchmark averaged 6.5%. Using a 10% discount rate might be appropriate here since it provides a margin above the risk-free rate. The discount rate is important when valuing cash flows. It is the rate at which future cash flows are brought back to the present. Because of the time value of money, $1 today is worth more than $1 in the future, the further into the future cash flows are, and the greater the uncertainty they will materialize, must be considered. Here we'll use a 10% discount rate for simplicity, which implies a multiple of 10 times. Based on this framework, Berkshire's pre-tax operating earnings per share of $421.39 and $258.20 were about $4,214 and $2,582 at year-end 1996 and 1995, respectively. Adding the per-share values of investments and operating earnings, we find that Berkshire's per-share intrinsic value increased by approximately 33% during 1996, but the share price increased just 6% during that time. Berkshire's price to estimated value decreased from a rich 1.3 times to 1.04 times, just about parity. The valuation exercise above also lends to the discussion of the issuance of the new B shares during 1996. At the time, Buffett and Munger said the shares were not undervalued, and their issuance would not decrease Berkshire's per-share intrinsic value. Since the shares were issued at a price just over the year-end 1995 share price, which was at a price to estimate value of 1.3 times, the assertion holds. Flight Safety International. Berkshire's 1996 share count was also affected by the issuance of shares to acquire Flight Safety International, a new operating subsidiary that trained pilots using flight simulators. Berkshire paid a total of approximately $1.5 billion for the company and funded it with 51% cash and the remainder in A and B shares. See Table 6.7. Altogether, 17,728 A shares and 112,655 B shares were issued to acquire Flight Safety. The Flight Safety acquisition came to Berkshire via Richard Server, a shareholder of both Berkshire and Flight Safety, who was familiar with Buffett's annual advertisement for seeking acquisitions. Flight Safety was the result of a lifetime of work by then 79-year-old founder Al Ueltschi. Ueltschi was an aviator who once piloted for Charles Lindbergh. The company manufactured and operated high-technology flight simulators for pilots of various types of aircraft. The flight simulators were indispensable to aircraft operators since they trained pilots in a realistic environment at a fraction of the cost and, perhaps more importantly, without the risk of operating an actual aircraft. Flight Safety represented a shift in Berkshire's acquisition philosophy. The business was a capital-intensive operation with 41 locations and 175 simulators. The simulators cost up to $19 million apiece to manufacture. Furthermore, they became outdated each time new aircraft were introduced into the market. Balancing out the capital-intensive nature of the business was a huge moat, something Berkshire admired and sought in acquisitions. Since competitors would have to invest tens of millions of dollars for a single simulator, the price of entry was steep. This provided a potential competitive advantage. Flight Safety's long history also gave it knowledge base to build simulators, supply its customers with numerous machines in numerous locations, and work with aircraft manufacturers to more quickly introduce machines for new aircraft. This deep well of knowledge earned it a joint venture with Boeing and a government contract through Raytheon. Analyzing Berkshire's acquisition of Flight Safety, we can conclude it was a fair price for a good company. Berkshire's effective purchase price, deducting excess investments on the balance sheet, resulted in a going pre-tax return of 8.7%. This seems very low at first glance, and it is, but Berkshire would benefit from Flight Safety's historical returns on capital and the moat protecting those returns. Any future growth the company might achieve, if anywhere near its historical returns on capital, would more than make up for the low initial return. On top of this, the company came with a passionate founder-manager. That he was 79 years old only endeared him to Buffett even more. An observer might conclude from our hiring practices that Charlie and I were traumatized early in life by an EEOC bulletin on age discrimination. The real explanation, however, is self-interest. It's difficult to teach a new dog old tricks, Buffett wrote. Like Mrs. B at Nebraska Furniture Mart, Ueltschi was still on top of his game. Kansas Bankers Surety. Berkshire's other much smaller acquisition of 1996 provides another lesson in business moats. Kansas Bankers Surety, per its name, wrote insurance policies for banks. It provided directors and officers insurance, excess deposit insurance for depositors above the FDIC limit, and other related areas of coverage. Due to its relatively small size, KBS was tucked into Wesco's insurance operations. The business was run by Don Toll and had just 13 employees. The lesson in Kansas Bankers Surety was that its relatively small size and limited opportunities for growth were the source of its competitive advantage. This sounds counterintuitive, but it's straightforward after some examination. The business required intimate relationships with hundreds of bankers, a process that takes time to build. With a limited number of clients and relatively slow turnover in bank executives, gaining an edge on Kansas Bankers Surety was hard. It was in a class of wonderful businesses that had natural size limit, but which generated a lot of surplus cash flow. Berkshire was more than happy to be a home to such a business. Insurance. Berkshire's insurance operations fell into two broad categories. The reinsurance group included the super catastrophe lines, or supercat, the relatively plain vanilla reinsurance business of taking on the risk entered into by primary insurers, in addition to the structured settlements business. The primary group encompassed everything from National Indemnity's specialized auto line and home state companies to the workers' compensation business. Geico, now a wholly owned subsidiary of Berkshire, fell squarely into the primary category. Owing to its size, Geico's operations were more than 10 times that of Berkshire's other primary lines combined. Geico was reported separately. Berkshire's insurance group, now led by Geico, was hitting on all cylinders. The overall result for the group was a pre-tax underwriting gain of $222 million on earned premiums of $4.1 billion. Aided by Geico, Berkshire's float nearly doubled from $3.6 billion in 1995 to $6.7 billion in 1996. Insurance, reinsurance. Berkshire earned $758 million in reinsurance premiums in 1996 and wrote to a 101% combined ratio. The segment was greatly aided by the supercat business, which turned in an underwriting profit of $167 million on earned premiums of $268 million. This was the third straight year of significant supercat underwriting gains, which prompted Buffett to warn that the ride would be bumpy despite expected satisfactory results long term. What you must understand, however, is that a truly terrible year in the supercat business is not a possibility, it's a certainty. The only question is when it will come. He even advised shareholders to reduce their estimates for Berkshire's earnings during years of above-average profitability when calculating Berkshire's intrinsic value. While the policies Berkshire wrote in 1996 were large, they were not unreasonable compared to his capital position. Buffett thought a worst-case after-tax loss from a true mega catastrophe to be around $600 million, less than 3% of Berkshire's book value and easily absorbed by earnings from its other businesses. Berkshire could do better than its peers over time by striving to underwrite each deal profitably and letting results fall where they may, rather than attempting for a smooth outcome each year. Indeed, Berkshire's reinsurance business model could be described as profiting from the desire of other insurers to smooth their underwriting experiences in an uncertain world. Berkshire had three major competitive advantages in the supercat business. 1. The marketplace. Berkshire had a reputation of having the capital to pay its claimants and paying them fast, even under the very worst of circumstances. 2. Price and timing. Berkshire would always have a great willingness to write business at the right price. When times became tough, other reinsurers might pull back from the marketplace. Berkshire's reputation was now such that it was earning standby fees from other reinsurers. This gave the reinsurers comfort that Berkshire would write them a policy if others wouldn't. 3. Large policies. Berkshire had the ability and willingness to write large policies. Buffett and Berkshire's insurance whiz, Ajit Jain, stood ready to commit to evaluate risks, price coverage, and respond to its customers very quickly. Perhaps demonstrating how open the insurance business really was, Buffett wrote that Berkshire tried to price our supercat exposures so that about 90% of total premiums end up being eventually paid out in losses and expenses. Berkshire's advantage was that it was willing to walk away from risks it didn't understand. Others relied on computer models that offered a false sense of comfort. Some direct writers were unknowingly the biggest supercat writers. Companies writing business in certain geographic areas, such as on Long Island, might have the most risk. A single large hurricane could cause wind damage to an entire portfolio of claimants diverse in all ways except their geographic exposure to one large, infrequently occurring risk. They don't think of themselves as being in the supercat business, but they are very exposed. The other half of Berkshire's reinsurance operations, making up $490 million of earned premiums in 1996, was the property and casualty excess of loss and quota share business. This line was more straightforward and less volatile than the supercat business. Though the segment turned in an underwriting loss of $101 million in 1996 and a similar size losses in prior years, these were long-tail type policies that produced a significant float for Berkshire. When priced appropriately, they would produce satisfactory results over time. Insurance, primary group. Berkshire's legacy primary lines, its bread-and-butter insurance businesses, produced excellent results. On $268 million of earned premiums, the group turned in a combined ratio of 78.2%, good for an underwriting profit of $59 million. Buffett singled out the managers responsible for producing this achievement for Berkshire: Don Worster at National Indemnity, Rod Eldred of the Home State Operation, John Kaiser at Central States Indemnity, and Brad Kinsler, who ran the Workers' Compensation Group and expanded it into 6 new states during 1996. Insurance, Geico. Berkshire's new gem, Geico, run by Tony Nicely on the underwriting side and Lou Simpson on the investment side, also received well-earned praise. Buffett was clearly excited about its prospects. There was nothing complicated about Geico, but its advantages were huge. Geico's competitive advantage stemmed from being the low-cost operator and using a direct-to-consumer business model among competitors entrenched in a broker model. In 1996, Geico's customers referred 1 million others to the company, which produced better than 50% of its new business. The savings on acquisition expenses were then passed on to customers in a virtuous cycle. Employees at Geico, from Nicely down, focused on 2 metrics: growth in voluntary policies in force, and the profitability of seasoned business on the books for more than a year. It was a very simple operating philosophy: bring in more customers and make sure those that stayed were profitable. This incentive structure formed the basis of all bonuses at Geico. The 2-part structure was carefully designed to maximize the benefit for Geico's owners, now Berkshire Hathaway shareholders. By focusing on the profitability of seasoned business, the underwriting part of the equation sought to ensure Geico was pricing its product appropriately for the long term and rejecting unprofitable risks. Because it excluded customer acquisition expenses associated with bringing in new business, which hurt profitability in the short term, the structure incentivized actions that built long-term value. This allowed for liberal spending to drive future results of the business. As simple as this incentive structure was, Geico's competitors, and especially public companies, followed other paths. Beholden to the short-term thinking of Wall Street, these companies often put near-term earnings first and sometimes starved their marketing budgets. Geico's path from being the 6th or 7th largest auto insurer in the country to being one of the largest was the result of its long-term strategy. It is worth noting that Simpson, Geico's longtime investment manager, remained on to manage Geico's investment portfolio after the merger. This said a lot about how highly Buffett viewed Simpson's investment prowess. With every other insurance acquisition, Buffett had taken over the investment part of the equation and left the managers to focus on the underwriting side. In 1996, Geico's first year under the Berkshire roof wholly owned, it wrote to a 94.5% combined ratio, producing an underwriting gain of $171 million pre-tax. Manufacturing, publishing, and retailing. The manufacturing, publishing, and retail segment continued impressive operations. Earning $378 million pre-tax in 1996, the group produced a pre-tax return on invested capital of 30%. In isolation, it represented a great result, but it marked a sharp decline from the 38% return earned in 1995 and the 49% result in 1994. Deteriorating profitability in the shoe group over the past few years explained part of the decline. The addition of capital-intensive flight safety explained the drop in 1996. Most of the businesses in this category continued to contribute as they had in the past. A few business units are worth highlighting. While the going was still tough at World Book, the business had made some progress. It was now the only direct seller of encyclopedias after Encyclopedia Britannica stopped its business line. World Book also partnered with IBM and invested heavily in a new CD-ROM product. Pre-tax operating earnings at the unit grew 43% to $12.6 million, but remained below the $25 million profit earned in 1994. Operating earnings at the Buffalo News grew 7.7% to $50.4 million. The gain was partly because the prior year had higher one-time charges due to employee severance costs and certain depreciation adjustments. The current year benefited from lower newsprint costs, which came back down after skyrocketing in 1995. The shoe group saw profits increase 5.5% to $61.6 million, but they remained far below the $86 million earned just 2 years before. Management successfully capitalized on opportunities to market and distribute product and lower overhead costs. More profits were expected in the coming year. Helzberg, Berkshire's newest jewelry acquisition, stumbled during 1996 and brought jewelry profits down 18% to $28 million. Increased expenses in anticipation of a large revenue increase that never materialized caused the disappointment. Buffett said CEO Jeff Comment was addressing the expense problem in a decisive manner and that he expected increasing earnings in 1997. U.S. Air Update. The saga of Berkshire's investment in U.S. Air preferred stock continued. Only this time it was news to the upside. Despite the many mistakes Buffett admitted making with the investment, there was one bright spot. The preferred stock included an unusual provision stipulating penalty dividends, 5 percentage points over the prime rate for payments that were in arrears. Since U.S. Air had skipped 2 years of preferred dividend payments due to operating troubles, this provision was triggered. The regular 9.25% dividend was now closer to 14% for the last 2 years. This penalty provision gave U.S. Air an incentive to pay the amount in arrears. Buffett praised company CEO Stephen Wolf for working to right the ship. While he asserted that U.S. Air still had basic cost problems that must be solved, Wolf's actions saved Berkshire's investment such that Buffett now thought it worth its $358 million par value. Not one to bask in glory, Buffett admitted to twice trying to unload the U.S. Air stock, first in 1995 and again in early 1996. Both efforts failed. Buffett told shareholders after the second attempt, "You're lucky. I again failed in my attempt to snatch defeat from the jaws of victory." The Walt Disney Company. In March 1996, the Walt Disney Company acquired Capital Cities ABC in a cash and stock transaction. The deal was born of a meeting between Michael Eisner of Disney and Tom Murphy of Cap Cities ABC at a Sun Valley retreat. While Buffett attributed the meeting to his influence, he later said that he thought the deal would have eventually materialized on its own. Berkshire received a total of $2.5 billion, of which $1.2 billion was in Walt Disney stock, which Berkshire retained, and the remainder in cash. The event caused a $2.2 billion realized gain. Salomon debt issue. During 1996, Salomon Brothers, Berkshire's go-to investment bank, sold an unusual security for Berkshire. The security was a $500 million 5-year debt issue that was convertible into shares of Salomon stock owned by Berkshire. Responding to a question about the issue at the 1997 annual meeting, Buffett noted that it's a way of taking capital out of that block of stock at a low interest cost to use elsewhere, while retaining a limited portion of the upside in the Salomon stock. With stocks generally trading at elevated levels, Berkshire was again taking advantage of favorable financing opportunities, independent of any immediate need for capital. Investment lessons. Buffett provided some explicit words of wisdom for investors in his chairman's letter and the annual meeting. He stressed the advantages of a low-cost index fund, which he thought would over time beat the great majority of investment professionals. Addressing attendees at the annual meeting, he said investing is the only field in the world where the amateur, as long as he recognizes he's an amateur, will do better than the professional. Buffett frequently pointed to his own shortcomings and limitations with respect to investing. He thought investors wanting to strike out on their own and construct their own portfolios should clearly define their circle of competence and stick to it. You don't have to be an expert on every company, or even many, he wrote shareholders. Your goal as an investor should simply be to purchase at a rational price a part interest in an easily understandable business whose earnings are virtually certain to be materially higher 5, 10, and 20 years from now. These companies were rare, so investors should load up when they found one. Buffett pointed to Berkshire's own look-through earnings, which had risen in tandem over time with Berkshire's stock price, as an example of his counsel in action. The best part about investing was that it was cumulative. Buffett had studied many businesses for years, even using flight safety as an example of one he read about for 20 years before learning enough to purchase it. All it took to be knowledgeable about many businesses and industries was time and an interest in continual learning. Compounding knowledge would lead to compounding money. Class B common stock issuance. Up until 1996, Berkshire Hathaway had only one class of common equity. Buffett's unwillingness to split the stock to cultivate and maintain a certain shareholder base meant its shares were priced significantly higher than the average issue. Companies typically split shares to keep prices in the affordable range of $20 to $100. Berkshire's shares had never been split, and its per-share price, over $33,000, reflected that fact. This caused some problems for shareholders wishing to make gifts, but the problems were surmountable. The 1996 proposal to issue Class B shares was a defensive move on Berkshire's part. It was partly to protect potential investors and partly to protect Berkshire's reputation. Berkshire had successfully foiled many plans to create a unit trust stocked solely with Berkshire shares by appealing to the promoters of the trusts. Now it seems someone was ignoring those pleas and at least one trust might be created. The potential unit trust would buy Berkshire shares on the open market and then sell shares in the trust to prospective investors wishing to buy less than whole shares of Berkshire common stock. Buffett and Munger thought such a proposal would harm investors in two ways. First, through the fees that would cause the investment to lag that of true Berkshire shares. Second, the incentive to grow those fees would cause the promoter to market the trust by promoting the high rate of return which had been achieved in the past, but which Buffett said was not repeatable. There was also the issue of supply and demand. The unit trust would have a fixed number of shares. Heavy promotion might cause the price to exceed the value of the underlying Berkshire shares. Investors would do worse than the underlying Berkshire shares as the discrepancy corrected itself over time. The high expectations of such a Berkshire unit trust investment could also harm Berkshire and Buffett's reputation. If purchasers of such a trust bought in at a high price relative to the underlying Berkshire stock, its performance would surely be disappointing over time. Even if Berkshire were not to blame, which it wouldn't have been, the negative association would remain. To thwart the promoters, Berkshire devised a plan to create a subclass of shares that would represent direct ownership, but at slightly disadvantageous terms. The newly created B shares would be priced at 1/30th of that of an A share, the original share class, but they would have voting rights of just 1/200th of the A shares. Further, only the A shares would be eligible for the charitable contributions program. In this way, there would be a slight advantage to owning the A shares, but the newer B share investors would still be owners of the company. Berkshire went even further to temper expectations and take the idea of a unit trust off the table. Guided by basic economics, Berkshire stated that it would issue as many shares as investors wanted. This would eliminate any possibility of outsized demand from temporary excitement, since Berkshire would just issue new shares to satisfy demand. Additionally, the A shares would be convertible at the option of the holder into 30 B shares, but the privilege would not go the opposite way. If B shares traded higher than the equivalent A shares for some reason, arbitrage would ensure the differential would not become too great. An investor could buy A shares, convert them to B shares, and then sell them at a higher price. The parts would be more valuable than the whole. Lastly, Berkshire publicly stated, including in the prospectus offering, that both Buffett and Munger did not think Berkshire was undervalued at the issue price and that they were not interested in purchasing shares at that price. Some shareholders thought this meant Berkshire was overvalued. Buffett made clear that should not be inferred. He said saying that Berkshire was not undervalued was not the same as saying it was overvalued. Based on Berkshire's book value at the end of 1995, the new shares would have valued the company at over twice book value. When the actual issuance was completed, the expected $100 million offering was oversubscribed. Berkshire ultimately ended up issuing 517,500 new B-class shares, which brought in just under $565 million. With no immediate plans for the money, Berkshire put it into the pool of capital available for other opportunities. Munger put the new shares in context. At about 1% dilution, he said the creation of the B shares was a non-event. Berkshire shareholders, not surprisingly, voted at the 1996 annual meeting to approve the B share issuance. The Berkshire Unit Trust idea never resurfaced, and Berkshire's reputation and shareholders were unharmed. The complete language of the offering, vastly different than anything typically found on Wall Street, is worth reading in its entirety. Warren Buffett, as Berkshire's chairman, and Charles Munger, as Berkshire's vice chairman, want you to know the following and urge you to ignore anyone telling you that these statements are boilerplate or unimportant. 1. Mr. Buffett and Mr. Munger believe that Berkshire's Class A common stock is not undervalued at the market price stated above. Neither Mr. Buffett nor Mr. Munger would currently buy Berkshire shares at that price, nor would they recommend that their families or friends do so. 2. Berkshire's historical rate of growth in per-share book value is not indicative of possible future growth. Because of the large size of Berkshire's capital base, approximately $17 billion at December 31, 1995, Berkshire's book value per share cannot increase in the future at a rate even close to its past rate. 3. In recent years, the market price of Berkshire shares has increased at a rate exceeding the growth in per-share intrinsic value. Market overperformance of that kind cannot persist indefinitely. Inevitably, there will also occur periods of underperformance, perhaps substantial in degree. 4. Berkshire has attempted to assess the current demand for Class B shares and has tailored the size of this offering to fully satisfy that demand. Therefore, buyers hoping to capture quick profits are almost certain to be disappointed. Shares should be purchased only by investors who expect to remain holders for many years. 1997. The stock market's continuing their upward trend, Buffett likened Berkshire's 34.1% per share increase in book value to a rising tide. He said Berkshire was the duck, and even though its gains beat the S&P by 0.7 percentage points, it was more attributable to luck than business acumen. This is not to say Berkshire did not make important gains during 1997. Buffett estimated intrinsic value increased in tandem with book value. Using the two-column method in our arbitrary, though consistent, 10 times multiplier on pre-tax operating earnings, we can calculate that Berkshire's intrinsic value grew about 38%, which is close to a 34% increase in book value. See Table 6.9. Buffett made sure to temper any enthusiasm. Berkshire's supercat business again experienced no major claims, and Geico had an unusually good year. Additionally, a rising stock market was making it harder to find good values there. He said prices were high and, if we swing, we will be locked into low returns. Buffett knew the value in waiting for the fat pitch, but found some things during 1997 to keep himself out of trouble. Unusual commitments. For Buffett, keeping himself out of trouble meant finding market inefficiencies to exploit. This involved 3 unusual investments: oil contracts, zero-coupon U.S. government bonds, and silver. The first was an investment in futures positions for 14 million barrels of oil. This was the remainder of a contract established in 1994 and 1995. The total profit from 45.7 million barrels of oil for those years created $62 million of profit for Berkshire. The second was the purchase of $4.6 billion, at amortized cost, of U.S. Treasury zero-coupon obligations. Paying no interest, they were a significant bet on a downward move in interest rates. The bet risked looking foolish if rates rose, but the odds were judged favorable. At year-end 1997, this bet was working out to the tune of almost $600 million. The third investment was in silver and proved the remarkable power of staying true to simple economic concepts. In this case, supply and demand. Berkshire had a position of 111.2 million ounces of silver at year-end 1997. Buffett and Munger invested in silver because they thought the world's supply and demand equation had gotten out of whack and that a higher price would be necessary to resolve the discrepancy. Buffett stressed that inflation played no part in the calculation. The logic was this. The world at that time used about 800 million ounces of silver each year, with 500 million ounces being produced and another 150 million ounces being reclaimed annually. A 150 million ounce shortfall existed. Since inventories were low, the demand would soon outstrip supply and cause a rise in price. There was an important nuance to this investment, and it highlighted the concept of inelasticity. Very simply, inelasticity in economics refers to the degree to which a given thing is price sensitive. Since the supply of silver came largely as a byproduct of mining other metals, its supply was price inelastic. This meant that no one was out there prospecting simply for silver. Supply of silver was based on the fundamentals of other metals. More demand did not induce additional supply. The demand side also had some inelasticity. Silver was used in photography and jewelry, but demand for silver was not overly sensitive to price. Combine these factors and it created a situation that clearly favored an upward price shift eventually. Like other investments, Buffett knew the if, but not the when. Charlie Munger pithily dismissed the investment at the 1998 annual meeting as being something that Buffett patiently studied for decades, only to invest 2% of Berkshire's assets. In other words, it was not something to be excited about because it wasn't going to move the needle at Berkshire. Compared to Berkshire's multi-billion-dollar investments in Coke, Gillette, and others, it really was a non-event. Still, for our purposes, the investment is interesting and instructive. Insurance. Aided by several positive factors, the insurance group hit it out of the park in 1997. Insurance earned almost $4.8 billion of premiums and wrote to an underwriting gain of $462 million before tax. Insurance Reinsurance Group. With no super catastrophes in 1997, $283 million out of $310 million of catastrophe excess of loss premiums fell to the bottom line as profit. But the possibility of losses materializing in any given year were meaningful, and they were certain to occur at some point in the future. With an enlarged capital base and appetite for new deals, Berkshire was willing to suffer a $1 billion loss without any discomfort. Berkshire had confidence in its pricing of risks and knew that over time the odds would be in its favor. Losses in other property casualty lines of $73 million and $82 million in losses from retroactive reinsurance and structured settlements brought the reinsurance group gain down to $128 million. While the lack of loss experience, catastrophes, and ensuing expensive damage claims in SuperCat was a near-term positive, it did bring unwelcome consequences. The insurance industry had long suffered from the ebbs and flows of capital coming into the industry during times of small losses, only to retreat when large losses came. The budding threat was now a new financial instrument dubbed catastrophe bonds. Buffett disliked catastrophe bonds, but not because they represented competition. He disliked them primarily because he thought they would likely be sold to unsophisticated buyers. Buffett defined them as investors, using quotes to suggest they were not informed buyers. The word bond would induce prospective buyers to associate them with the safety inherent in traditional bonds, such as those sold by corporations or governments, when in fact they were really an instrument designed to circumvent state laws, preventing unlicensed insurance activity. He also called them an Orwellian misnomer because they were not like a bond at all. They were more like a mispriced layer of insurance. Whereas a true bond requires the issuer to repay the debt using income and is usually backed by assets, these were more like reinsurance and put the greater risk on the purchaser. This is how it worked. Investors put up money to back a pool of risks. If no risk materialized, the investor would receive a payment. Unlike a traditional bond, however, if a loss event did occur, the bond capital was used to make the issuer whole, leaving the bondholders empty-handed. Like other kinds of capital influx, lower volumes were expected in the years ahead. Insurance, Geico. Geico, already a shining gem, shone brighter than ever in 1997. After a record-setting 10% growth in 1996, Geico, led by Tony Nicely, rocketed to 16% growth of in-force business in 1997. Geico turned in an underwriting profit of $281 million, up 64% from the previous year. The resulting 91.9% combined ratio reflected Geico's low-cost operation and generally favorable conditions industry-wide. Using the same two-pronged compensation arrangement focused on growth in policies in force and the profitability of seasoned business, 10,500 Geico employees shared a $71 million bonus pool that amounted to almost 27% of base salaries. For Geico, an underwriting gain of over 8%, while not unwelcome, was too high. Targeting a 4% gain, meaning a combined ratio of 96%, Geico planned to cut its rates in the coming year. Geico would do better over time, passing the benefits of its low-cost operation back to customers to drive future growth. It planned to spend over $100 billion on advertising in the coming year to capture some of the $115 billion market. Huge potential to grow Geico's 3% market share. Insurance, primary group. Berkshire's other primary lines wrote to a 15% underwriting profit during 1997. Premiums earned increased 17% from the prior year and reflected the progress of the many smaller but excellent insurance subsidiaries in that group. Manufacturing, publishing, and retailing. Berkshire's financial reports reflected its growth. Insurance, including investment income, made up 78% of pre-tax operating earnings, up from 65% in 1994, so it was natural that more information was added to each segment as time progressed. The business in the non-insurance segment, by contrast, increasingly made up a smaller portion of the growing conglomerate. Consequently, certain businesses were lumped together for reporting purposes, but that didn't make them any less valuable. Together, these businesses earned 32.8% on average invested capital, up from 29.6%. Both Kirby and World Book were combined into one line along with the Scott Fetzer Manufacturing Group. Together, Scott Fetzer made up just 7% of Berkshire's consolidated pre-tax operating earnings in 1997. The Scott Fetzer finance operation remained a separate line item. The newly reconstructed Scott Fetzer, excluding finance, reported a 2% decline in pre-tax earnings to $119 million. Most of the other non-insurance operating businesses did better in 1997 than in 1996. An exception was the shoe group. Reflecting overall industry weakness, sales volumes declined 12% at Dexter, which was struggling against a tough retail environment that included imports. The company planned a new marketing strategy using global advertising. Pre-tax earnings from the shoe group declined 21% to $49 million. Sears was the bright star that never seemed to dim. In 1997, the business grew revenues 8.2% to $269 million. Long struggling with declines in pounds sold, the year saw a 5.5% increase in poundage. The reason is unclear. Perhaps it was the legions of shareholders returning home with memories of their candy indulgences during the annual meeting who helped increase quantity and mail order volume at Sears. In any event, Sears was finding ways to increase its unit volumes while continuing to implement annual price increases. It is interesting to compare Flight Safety's, Berkshire's first admittedly capital-intensive acquisition, to Sears. See Table 6.11. Looking solely at operating margins, one might conclude by the 7.5 percentage point difference that Flight Safety was the better business. Here the lesson of capital intensity comes into play. While Flight Safety generated a larger profit margin on revenues, its capital requirements were similarly large. Flight Safety had 19 times the assets of Sears, but generated only 50% more revenues. The greater operating margin at Flight Safety did not make up for the company's low level of revenues compared to its capital employed in the business. As a result, Sears enjoyed a spectacular 65% return on assets compared to just 7% at Flight Safety. Sears did not possess the ability to reinvest that Flight Safety enjoyed. This illustrated one of the many trade-offs in business. Sears generated excellent returns on capital but had no place to put their earnings except distributing them to Berkshire. Flight Safety, by contrast, could reinvest larger sums but at lower rates of return. Berkshire welcomed and needed both businesses. Star Furniture and International Dairy Queen. Another year, another acquisition. In 1997, Berkshire agreed to acquire Star Furniture and Dairy Queen, though the latter closed in early 1998. Buffett recommended how Irv Blumkin of Nebraska Furniture Mart and later Bill Child of R.C. Willey had both identified Star as a well-run furniture store. When Melvin Wolfe and his sister, Shirley Tooman, decided to sell the family business, they reached out to Salomon Brothers, who in turn introduced them to Buffett. Not long after, a deal was made to purchase the 12-store Texas-based furniture business. The price was not disclosed. International Dairy Queen was a bread and butter, burgers and fries really, operation fit well within the Berkshire family of businesses. When Berkshire Hathaway agreed to purchase the company in 1997, it had 5,792 Dairy Queen locations. It sold hamburgers, fries, and ice cream, among other similar offerings, and operated in 23 countries. The International Dairy Queen parent also operated 409 Orange Julius and 43 Caramel Corn franchise locations that sold other treats. In addition, there were 190 treat centers that combined some or all three of those brands. Most locations were franchised. Dairy Queen had a troubled history. After some years of operation that saw a jumbled mess of varying franchise agreements and too much debt, a Minneapolis group purchased the business in 1970. In 1997, one of the two owners died, and his estate sought to sell the business. The International Dairy Queen deal was structured similar to Flight Safety acquisition. A combination of cash and Berkshire stock was offered, with the cash portion slightly richer to induce sellers to choose that over stock. Despite this nudge, only 45% of Dairy Queen shareholders chose cash. The total purchase price was $587.8 million, and the merger closed on January 7, 1998. See Table 6.12. Like Berkshire's other acquisitions during this period, it paid a premium price for a company earning very good returns on capital. International Dairy Queen was a different economic model from McDonald's, a stock Berkshire previously owned and sold. While both companies were, and are, franchisors, McDonald's owned and operated about one-third of its locations and owned the underlying real estate of most locations. By contrast, International Dairy Queen operated a few of its locations, but was mostly a franchisor. That arrangement made for a relatively small investment in capital compared to McDonald's. International Dairy Queen treated its franchisees fairly with a franchise fee of 4% of revenues, which was at the low end of the spectrum for the industry. Under a section of his 1997 letter entitled A Confession, Buffett wrote that the International Dairy Queen and Flight Safety type acquisitions made with Berkshire shares had cost shareholders money. He was clear that such value-detracting moves were not due to the underlying companies, but instead because Berkshire's existing group of businesses were so great. He used a baseball analogy to demonstrate his point. Trading any player for a 350 hitter was a good idea in most cases, except when it was at the expense of a 380 hitter. His point was that Berkshire already had a star roster filled with wonderful businesses. Issuing Berkshire stock in any future acquisition meant trading away a small percentage of the ownership of these wonderful businesses. For this reason, Buffett wrote that, "You can be sure Charlie and I will be very reluctant to issue shares in the future." Even though it was flagged as a mistake, Buffett did not say Berkshire would stop issuing shares. Instead, Berkshire would offer splits such as that used in the International Dairy Queen acquisition that encouraged cash over stock. The stock-type deals would remain, but as an option in the cases where sellers desired stock as a currency. Investments. While usually changing at the speed of molasses, the Berkshire investment portfolio was not immune to some fluctuations. The inevitables, a word Buffett coined in 1996 to describe those companies destined to do very well over time, were still there. Berkshire had 49 million shares of American Express, 200 million shares of Coke, 1.7 million shares of the Washington Post, and 6.7 million shares of Wells Fargo. In addition, Berkshire still held its 64 million shares of Freddie Mac and 48 million shares of Gillette. All told, the $7.2 billion cost common stock portfolio had a market value of $36.2 billion at year-end 1997, with Coke making up almost 37% of it. The next largest was American Express at 12%. The listed securities, those with a market value over $750 million, totaled 8 in name and represented almost 88% of the portfolio. Included in the top 8 was a new name, Travelers Group Incorporated. Berkshire's 23.7 million shares of Travelers were as a result of the merger of Salomon with Travelers that netted Berkshire common and preferred stock. The architect of the Travelers deal was Sandy Weill, whom Buffett praised as a great manager with a proven record. Such comments provided an answer for why Berkshire continued with the investment. Responding to a question at the annual meeting about Coke, Buffett provided some remarkably candid insights into his and Munger's thinking on the investment. The question was whether and how to include the periodic gains reported by the company via its sales of bottlers. Buffett said he completely ignored such gains and instead focused on two variables. The two important elements in valuing Coke are unit case sales and shares outstanding, he said. Looking forward a decade or two, if one thought, which presumably he did, that Coke would be selling multiples of its present volume and the number of outstanding shares were expected to go down, the company was a repurchaser of its own shares, it was as far as you needed to go in analysis. Of course, there was more to that conclusion, including the knowledge of the superiority of Coke's worldwide distribution system. At the end of the day, these two variables remained and told a compelling story. No wonder Coke made up over 1/3 of the portfolio. In addition to disposing of the McDonald's investment, Berkshire also trimmed its holding in certain larger positions, including Walt Disney, down 12% to 21.6 million shares, Freddie Mac, down 0.5% to 64 million shares, and Wells Fargo, down 8% to 6.7 million shares. In total, about 5% of the beginning value of the portfolio was sold and shifted into fixed maturity investments, including increased holding in treasuries and other government securities. One noteworthy category of bonds largely missing from the mix were corporates. At year-end 1997, the portfolio contained just a $35 million allocation, largely unchanged from 1996. On the whole, Berkshire's 1997 investment portfolio was comprised of $10.3 billion of fixed maturity investments and $36.2 billion of equity securities. The resulting stock-bond split was 78 to 22. This compared to the 1996 portfolio with $6.4 billion in bonds and $27.8 billion in equities, a split of 81 to 19. Buffett thought the equity market was at such a level that little to no margin of safety existed at current prices. If interest rates remained where they were or fell, and if returns on equity remained high, as they were in late 1997 and early 1998, then markets would not be overvalued. Judging by Berkshire's actions, Buffett seemed to be leaning toward a judgment of overvaluation. 1998. Normally, a gain of 48.3% would call for handsprings, but not this year, Buffett wrote to shareholders in his 1998 chairman's letter. After several years of such talk, Berkshire delivered average annual gains in per-share book value of 39% over the prior 4 years compared to 31% for the S&P 500. Shareholders might again dismiss this as Buffett being Buffett, but this year really was different. Berkshire did find sensible things to do during 1998, especially against a backdrop of an ever more expensive stock market, but the per-share gains in book value were not as good as they looked. The gain in 1998 was mostly due to issuing shares to make business acquisitions. For someone who had written just a year earlier that it was a mistake to issue shares in prior acquisitions, 1998 was a veritable spending spree with shares. So why did Berkshire do it? Presumably, Buffett and Munger thought their simple test had been met. In these cases, Berkshire received as much in value as they gave by issuing new shares. During the year, Berkshire acquired 3 new businesses. The International Dairy Queen merger at the beginning of January, discussed in the 1997 section, Executive Jet, and Berkshire's largest acquisition to date, General Reinsurance, sometimes referred to as General Re. Because these deals all involved issuing above-book value shares of Berkshire, the transactions instantly increased per-share book value figures. What wasn't instantaneous was a change in per-share intrinsic value if equal intrinsic value was given as received. Berkshire's per-share intrinsic value did increase during the year, but it was well short of the gain in book value per share, and therefore not a cause for celebration. Continuing to use the two-column method, see Table 6.14, Berkshire's intrinsic value increased an estimated 16%, far short of the change in book value. 2 items in the 1998 analysis deserve extra attention. One is the fact just discussed that Berkshire's book value increased along with the issuance of shares. If we presume a one-to-one exchange of value, this had the effect of decreasing the proper price-book multiple necessary to arrive at Berkshire's intrinsic value. This decline was probably less than the change shown in the table due to the second factor. General Re reported a loss in 1998, which depressed Berkshire's operating earnings. Had Berkshire not acquired General Re, operating earnings would have increased slightly. General Reinsurance Corporation. Berkshire completed the $22 billion acquisition of General Re on December 21, 1998, issuing 272,200 A equivalent shares for the company. It was by far Berkshire's largest acquisition to date. General Reinsurance was, as its name suggested, a reinsurance business. The name General Re was technically the parent company that conducted professional property and casualty reinsurance under the names of General Reinsurance Corporation and National Reinsurance Corporation, the largest such outfit in the United States. General Re also owned an 82% interest in Cologne Re, a major international reinsurer and the oldest in the world. Through Cologne Re, General Re also reinsured life and health insurers. Why was Berkshire interested in acquiring General Re? The answer required a word previously anathema to both Buffett and Munger: synergy. The reasons were laid out in the press release announcing the acquisition. 1. Many investments. General Re would almost double Berkshire's investment portfolio with its $24 billion or $80,000 per A share equivalent issued. 2. Expansion of General Re's ability to write business. Earnings volatility would not factor into underwriting decision-making, as was the case when it was a public company. 3. The ability to expand internationally. 4. Tax considerations. Berkshire's large base of taxable earnings outside of reinsurance would allow General Re to maximize the value of its investment portfolio. 5. Abundance of capital. Berkshire's large capital base would allow General Re to operate unconstrained and write any business that made sense. The merger was summed up as follows. These synergies will be coupled with General Re's pristine worldwide reputation, long-standing client relationships, and powerful underwriting, risk management, and distribution capabilities. This combination virtually assures Berkshire and General Re shareholders that they will have a better future than if the two companies operated separately. General Re was like Berkshire's homegrown General Re was like Berkshire's homegrown reinsurance business in that it was paid for absorbing the volatility of other insurers. It was unlike Berkshire's existing insurance business in that it was publicly held. Publicly held companies are praised for their smoothness, which goes against the nature of reinsurance. Under Berkshire's umbrella, General Re could take on more volatility, assuming it was properly priced, and live up to its potential. Hidden risk would soon come to light, but this potential was the basis of the acquisition. Buffett also thought highly of General Re's management team. CEO Ron Ferguson was offered a position on Berkshire's board of directors, but he declined. Like Berkshire's other acquisitions, Ferguson will be left alone to run his business, although General Re's investment portfolio would now be under Buffett's direction. Cologne Re would remain as it was prior to the Berkshire acquisition, with its portfolio managed as before. Some figures illuminate the size of General Re's operations. As evident in the $22 billion price tag, its business was large, see Table 6.16, compared to the Berkshire Hathaway Reinsurance Group, which wrote just $1 billion in premium volume during 1998 and earned slightly less. General Re was huge. In 1998, General Re wrote and earned about $6.1 billion of premium volume across three main reporting lines. The largest, at about $2.7 billion, or 44% of its premiums, was the North American Property Casualty segment. International Property Casualty followed at $2.1 billion, or 35%, and the Life Health division wrote and earned about $1.3 billion, or 21% of General Re's volume. General Re's $370 million underwriting loss in 1998 was the one apparent blemish. This translated into a combined ratio of 106.1%. The company's long-term track record of success told a better story. Over the prior 50 years, General Re stood out for its nearly break-even combined ratio of 100.4%, though this included the most recent 5- and 10-year track records averaging 101%. General Re brought with it approximately $14 billion of float. This tripled Berkshire's float in 1 year's time to $22.8 billion at year-end 1998. To acquire this float, Berkshire paid a premium of 1.57 times the $22 billion price tag versus the $14 billion of float for General Re. Float, as Buffett noted many times, could be very valuable, especially if it grew and/or came at a lower negative cost. But General Re's large float came with a near break-even cost, and Buffett did not expect it to grow very much. There were the synergies laid out in the press release, but could these facts alone justify the purchase price? Paying up for a business like Geico with its profitable and rapidly growing float made sense, but why pay such a premium for what seemed to be average quality float? The answers might lie within the valuation of the Berkshire currency at the time. In other words, Berkshire's share price. The merger was completed late in 1998, but the price was established mid-year based on an average closing price over a 10-day period. At the time, Berkshire was trading at over $80,000 per A share. Even conservatively estimating Berkshire's intrinsic value using the year-end 1998 figures, which includes General Re, book value grew mid-year and year-end, it appears the shares issued in the merger were overvalued by as much as 54%. Adjusting for this overvaluation, we can conclude the price paid for General Re was not as rich as at first glance. This is consistent with Buffett's comments that as much intrinsic value was given as gained. One last item is noteworthy with respect to General Re. The acquisition brought analysis attention to Berkshire because of General Re's institutional shareholder base. One of those analysts was Alice Schroeder, who later wrote The Snowball, the only authorized biography of Buffett. Schroeder, then an analyst at Payne Weber, wrote a research report on Berkshire that Buffett praised greatly. The analyst's attention would also provide a benefit for Berkshire, or at least Buffett, in that they could field calls from institutions or others about Berkshire. Since Berkshire had no investor relations department and Buffett wanted a level playing field between all investors, i.e. no special meetings with him even for large shareholders, the few analysts that now covered Berkshire were a plus. Berkshire Hathaway Reinsurance Group. Berkshire's existing reinsurance operations swung to a $21 million loss on earned premiums of $939 million, down 3%. Super Cat premiums declined 8% to $286 million, but another year of low loss events left a $155 million profit. Losses from other property casualty business totaled $86 million, and retroactive reinsurance and structured settlements recorded underwriting losses of $90 million. Geico. Geico once again simply shot the lights out. Those were Buffett's words of praise in his 1998 chairman's letter. Even after reducing pricing on average 3.3% to lower its underwriting profits to its target level of 4%, favorable weather conditions and lower accident severity led Geico to deliver big for Berkshire. Premiums written were up 16% over 1997, and Geico's underwriting profit of $269 million, or 6.7% of premiums, remained too high. Additional price cuts will be necessary in 1999. Geico brought in 1.3 million new voluntary auto policies during the year, which took total policies in force to over 3.5 million. The growth in new policies together with the outsized underwriting profit produced great results for Berkshire and for Geico's 9,313 associates. Geico paid out a record $103 million, or almost one-third of base salaries and bonuses, to its employees. This was the highest on record for the company. Not slowing down one bit, Geico planned to spend $190 million on advertising in the coming year to spur growth. The campaign was working. Market share had risen from 3% to 3.5% in 1998. Berkshire Hathaway Primary Group. Berkshire's other slate of insurance businesses continued slow yet below-the-radar success in 1998. The group earned $328 million in premiums and turned in a combined ratio of 94.8%. This myriad group that formed Berkshire's foundation now accounted for just a fraction of its total volume given the General Re acquisition. As small as they were individually or even collectively, they were still an important contributor to Berkshire. This was especially true given their ability to generate negative cost float. Since the General Re acquisition did not close until very late in 1998, its 1998 underwriting loss did not materially affect Berkshire's consolidated insurance results. In all, including the 10 days of General Re's results, and largely due to Geico, Berkshire's insurance group reported a pre-tax underwriting gain of $265 million, another year of cherished negative cost float. Investments. The General Re merger moved Berkshire's investment portfolio even heavier into bonds, a direction Berkshire was purposely heading. Changes in 1997 took Berkshire's bond allocation from 19% of its $47 billion portfolio to 22%. General Re maintained a higher concentration of bonds, and Berkshire requested that it dispose of its 250 stock equity portfolio prior to the merger. Post-acquisition, Berkshire's investment portfolio grew to $61 billion with a 35% allocation to bonds. There were some important changes in the composition of the bond portfolio year over year. Most notably were higher exposures to foreign governments and a more meaningful investment in corporate bonds. There were also some meaningful changes to the equity portfolio during 1998. The elimination of McDonald's was discussed earlier, which in hindsight Buffett regretted selling. Buffett also reduced or eliminated smaller positions and added to American Express, buying an additional 1.08 million shares. With stock markets reaching new heights in general and tech fever raging, Buffett and Munger received several questions at the next annual meeting about investing in dot-coms. Why, some asked, if Buffett so admired companies such as Intel and Microsoft, hadn't Berkshire invested in technology? Buffett reiterated his philosophy. He and Charlie looked for businesses about which they could be fairly certain of their 10 to 15-year prospects. Technology companies didn't pass through that filter. Buffett said that in 1998, just 400 companies in the United States earned $200 million a year after tax. Yet there were many internet companies with no such earnings being valued on the same basis as some long-established and profitable enterprises. That math just didn't work out, he said. In the end, they have to succeed as businesses. This sound explanation did not stop other shareholders from prodding Buffett about his reluctance to change his ways. Fortunately for Berkshire shareholders, both he and Munger were comfortable owning basic, boring businesses. After all, $1 earned in technology operation was worth the same as one from an old-fashioned business. Change may be exciting for speculators and good for the citizenry at large, but it was a threat to long-term investment returns. Executive Jet. The newest non-insurance subsidiary joined Berkshire in August 1998. Executive Jet was the third company acquired with the issuance of shares in 1998 following General Re and International Dairy Queen. The purchase price of $700 million required half to be paid with Berkshire's shares. Unfortunately, we cannot readily determine the valuation Berkshire placed on Executive Jet because its results were not detailed separately. Executive Jet was a simple business. The company sold fractional interest in various aircraft, which were then managed by the company for use by its multiple owners. These fractionally owned aircraft supplemented the fleet of company-owned aircraft that Executive Jet could have available on short notice. The company was founded by Rich Santulli, who Buffett credited with creating the fractional ownership industry in 1986. Although both Executive Jet and Flight Safety were classified into the same flight services category, the businesses had important differences. Whereas Flight Safety was a capital-intensive business requiring significant upfront investments in simulators, Executive Jet was a capital-light operation. An aircraft's owners, whether a single owner or multiple owners, put up the capital to buy the plane. Owners also paid Executive Jet a monthly management fee and a fee to cover hours flown. Owing to the capital-light nature of the business and its advantages over direct ownership of single planes, Buffett was enthusiastic about the business. He had started using the service prior to owning the company. After buying Executive Jet, he even sold the Indefensible, Berkshire's own corporate plane. The company had real growth prospects, and adding more owners and planes would drive costs down as deadhead time, planes flying empty to pick up passengers, was reduced. In addition, More planes across the country meant shorter wait times for customers. Already, the company accounted for 31% of all corporate jets ordered in the entire world. Executive jet was half of the flight services category, flight safety and executive jet. This category earned $181 million and represented 10% of Berkshire's 1998 pre-tax operating income. Manufacturing, service, and retailing. If there was any question about the diminished relative importance of other businesses in this category, the word publishing was replaced by service in the segment header beginning in 1998. Flight services was mostly in a league of its own among Berkshire's non-insurance businesses, with its 10% of pre-tax operating earnings. The only other non-insurance business to earn as much was the collective of Berkshire's finance and financial products businesses. Within the now manufacturing, service, and retailing businesses, only Scott Fetzer, including its finance operations, came close at 7% of Berkshire's total. Scott Fetzer earned $137 million pre-tax, up 15% from a year before. Its after-tax profits of $96.5 million was an astounding 86% return on its $112 million of net worth. Also mentioning, not for its size but its 22% increase in earnings, were the jewelry businesses, which earned $39 million. The Buffalo News had another tough year and earned $53 million, down 5%, and Sears increased its earnings by 5% to $62 million. Finance and financial products. The inclusion of General Re's finance subsidiary in Berkshire's finance and financial products segment brought Berkshire's operation in this area back to the forefront, and with it a Wall Street-esque look to the balance sheet due to its complexity. Previously, the balance sheet primarily comprised borrowed funds, annuity liabilities, and equity, which financed interest-bearing receivables and investments. It now included securities marked to market, trading securities, and repo securities, among others. While some of this complexity would wind down over time, as it stood, the segment had a portfolio containing huge notional amounts of securities. The interest rate and currency swap agreements were largest at over $500 billion, $514,935 million of notional value. The balance sheet had $88 billion of options written and $90 billion of options purchased, in addition to significant futures and forwards contracts. While all of this netted against each other to a more modest $6.2 billion of trading account assets liabilities, it posed significant hidden risk for General Re and for Berkshire. Accounting lessons. Buffett took no less than 3 pages of the 1998 chairman's letter to rail against the accounting abuses committed by corporate America. Using General Re as an example, he wrote that the acquisition put a spotlight on an egregious flaw in accounting, namely that Berkshire would replace General Re's option plan with an economically equivalent cash plan. Since options had not been counted in the income statement, Buffett told readers that the proxy statement describing the merger contained a $63 million adjustment to correct for this fact. Buffett said that he and Munger made similar revisions to the earnings of the public companies they followed. It wasn't uncommon for the adjustments to reach a very meaningful 5% or 10% of earnings. In some cases, such adjustments were the difference between purchasing a stock or passing on a purchase. Restructuring charges were another sore spot. Companies would lump in all sorts of adjustments into one quarter, which would then be explained away and ignored by analysts. Even more egregious, such maneuvers sowed the seeds for future so-called earnings when charges were reversed. Such accounting machinations were the result of hyper-competitive environment with CEOs eager to please Wall Street and auditors that blessed such arrangements. Not surprisingly, both Buffett and Munger thought such practices despicable. Buffett lauded SEC Chairman Arthur Levitt for going after such abuses and urged shareholders to read a recent speech on the subject. As for Berkshire, Buffett would tell it as it is. Regular readers of his shareholders' letters would know that Buffett was telling the truth. If anything, Buffett took too many pains to point out his and Berkshire's shortcomings. Perhaps Berkshire was the better for it. 1999. The underperformance that Buffett had long predicted finally came true in 1999. Berkshire's gain in book value per share, Buffett's preferred, if only rough proxy, increased 0.5% compared to an increase of 21% for the S&P 500. Buffett told shareholders that 20.5% underperformance was the worst of his career and that he deserved a D for capital allocation. Still, Berkshire did have some bright spots during the year, including the completion of an acquisition and the arrangement of two more. The poor performance stemmed from a couple of different spots. The first was a lackluster performance by the marketable securities portfolio. Poor operating performance of the underlying companies caused their stock prices to decline, in turn impacting Berkshire's book value. The price declines were also likely exacerbated by the internet fever still gripping the country. The Nasdaq Composite rose fivefold between 1995 and 2000, but only for companies investing in technology stock. Berkshire had made no such investments. Additionally, mistakes at General Re, Berkshire's new reinsurance subsidiary, led to a large underwriting loss that caused a corresponding pre-tax operating loss, excluding investment income. Insurance. Berkshire reported its first loss from insurance underwriting since 1992. General Re contributed most of the $1.4 billion pre-tax loss, but weakness in other areas played a part. Berkshire's 5.8% cost of float approximated long-term U.S. government bond rates at the time. General Re. During 1999, mistakes of the past finally caught up with General Re. The reinsurer had significantly underpriced its business in both domestic and international markets. Buffett hinted that the culprit might have been the compensation structure at General Re and its majority subsidiary Cologne Re. Those structures were changed. At both companies, incentive compensation plans were now directly tied to the variables of float growth and cost of float, the same variables that determine value for owners. Yet even with perfect hindsight, Buffett said he'd make the same deal to acquire General Re. Just how bad were the 1999 results at General Re? On earned premiums of $6.9 billion, General Re recorded an underwriting loss of $1.2 billion, a combined ratio of 117.1%. General Re's results fell into three main components. North American Property Casualty, a pre-tax underwriting loss of $584 million on $2.8 billion of earned premiums, combined ratio of 120.6%. Reason for the loss? Inadequate premium rates, higher losses, and unfavorable loss development. International Property Casualty, a pre-tax loss of $473 million on $2.3 billion of earned premiums, combined ratio of 120.2%. Reason for the loss? Losses on a motion picture insurance contract, catastrophe losses resulting from European winter storms, earthquakes in Taiwan and Turkey, and a hailstorm in Australia. Global Life Health, a pre-tax underwriting loss of $127 million on earned premiums of $1.7 billion, a combined ratio of 107.4%. While the Global Life Health line at General Re was a relative bright spot during 1999 in terms of financial results, it bore the stain of a past mistake. Its 1998 underwriting loss was largely the result of the Unicover affair. According to an industry article written in 2014 by future CEO Tad Montross, participants in Unicover, a pool of life insurers, sold dollar bills for 50 cents via their hugely underpriced reinsurance of the policies. At the annual meeting, Buffett praised General Re for being one of the first to record the expected future loss, whereas some others had punted the loss recognition into future years. In a rare lapse, General Re had strayed from its circle of competence and was hurt, but Buffett thought it learned its lesson. Berkshire Hathaway Reinsurance Group. Berkshire's homegrown reinsurance operation, created and run by Ajit Jain, also posted an underwriting loss during 1999. Here things were a little different, as the loss largely reflected the expectations of volatility of results over time in reinsurance. The group continued to write large covers, and in 1999 it wrote $2.4 billion of premiums and earned just about the same, including a $1.25 billion from a single contract. The group's overall underwriting loss of $256 million pre-tax included a $220 million loss from a single aggregate excess contract, a type of reinsurance contract that produces a lot of float, but with one large upfront loss, during the fourth quarter of the year. Other non-catastrophe losses totaled $135 million, and retroactive reinsurance reported a loss of $97 million. With a profit of $196 million, the SuperCat business reported yet another year of gains. Berkshire Hathaway Primary Group. The direct or primary lines continued their understated success. Though premium volume slipped 20% to $262 million, the group wrote to an underwriting profit of $22 million, up 29%. In his letter to shareholders, Buffett praised Ron Eldred, Brad Kinstler, John Kaiser, Don Toll, and Don Worster for collectively earning $192 million in pre-tax underwriting profit over the preceding 5 years. Geico. Geico was still Berkshire's shining star, even if not as bright as the prior 2 years. Those years saw outsized profitability industry-wide, driven by lower accident rates and few to no catastrophe losses. Accordingly, Geico's combined ratios of 91.9% and 93.3% in 1997 and 1998 respectively were too low. In 1999, it returned to earth at 99.5%. Part of the reason for the return to a normal combined ratio were the effects of the higher claims and reduced pricing on the loss ratio. The other part of the equation was Geico's discretionary spending on advertising for customer acquisitions. Geico might only need to spend $50 million to maintain its policy count, but instead spent $242 million to grow its business in 1999 and expected to spend up to $350 million in 2000. Buffett said CEO Tony Nicely's foot is going to stay on the advertising pedal, and my foot will be on his. Buffett was willing to commit $1 billion a year to advertising if it would result in new business at an attractive cost. They didn't, in part because media rates were up, and each additional dollar of advertising had a diminishing return. Geico added 165 million new voluntary auto policies in 1999, bringing the in-force count to over 4.3 million. Its premium volume grew accordingly, and so did its float, up 10% from 1998 to $3.4 billion. It was around this time that Geico introduced the gecko, as Geico is often mispronounced gecko. The tiny green happy creature told people, "My job is to save people money. I love my job." His job was also to attract new customers, which made Geico a lot of money. A closer look at Geico's 1999 underwriting gains shows this. Included in underwriting expenses are all costs associated with running the business, including advertising. Included in underwriting expenses are all costs associated with running the business, including advertising. Excluded is losses and loss expenses. At 19.3% of premiums earned, underwriting expenses were about the same as the year before, but they would have been another 4 points lower without such heavy advertising. At other auto insurers, and especially publicly traded ones, growth spending might be held back to report higher profits. Geico, Berkshire, and Buffett were squarely focused on the future. This meant trading current reporting profits for a chance to capture a greater slice of the overall market. Geico's share was 4.1%, a cycle that would repeat successfully in the future. Jordan's Furniture. Jordan's Furniture found a new home at Berkshire Hathaway on November 13, 1999, in an all-cash transaction. Berkshire now owned what Buffett considered the 4 best furniture retailers in the country. The other 3, Nebraska Furniture Mart, R.C. Willey in Utah, and Star Furniture in Texas, had all told Buffett about Jordan's. Buffett hinted about this in previous annual reports without naming Jordan's. Now he could talk about it freely. Buffett said Jordan's had the highest sales per square foot in the country and was the largest furniture retailer in Massachusetts and New Hampshire. Jordan's was operated by Barry and Elliott Telemann. Their grandfather started the family business in 1927. Jordan's grew by turning shopping into an entertainment experience with soda, cookies, ice cream, and even an IMAX movie theater on site at some locations to augment the shopping experience. In later years, they would again lead the way by adding indoor rope courses, therefore attracting families for every reason but furniture shopping. Upon selling the family business to Berkshire, the Telemanns provided bonuses to longtime employees. They used $9 million of the sale proceeds to give each employee 50 cents for each hour they had been with the company. Each of Berkshire's furniture stores was the dominant furniture retailer in its geographical market. Together they were a furniture retailing powerhouse with revenues nearly $1 billion annually. Including Jordan's from the time it joined Berkshire in late 1999, Berkshire's Furniture Group reported $917 million in revenues for the year and $79 million of pre-tax operating profit. Neither the purchase price nor Jordan's earnings were publicly disclosed. Manufacturing, service, and retailing. Viewed as one business, the manufacturing, service, and retailing businesses earned $444 million pre-tax in 1999, which represented a return on capital of 26.7%, down 4.4 points. After tax and with modest leverage, it translated into a respectable 21.5% return on average equity. Most businesses performed well in 1999, but others struggled. The Shoe Group again reported a decline in pre-tax operating profit, down 52% to $17 million. Dexter was to blame. Its U.S.-produced product was badly impacted by imports. Over 90% of shoes came from outside of the U.S., where they had the advantage of low-cost labor. To compete, Dexter was making more shoes overseas. See's Candies again found success in its wholesale and mail-order program, bringing total poundage up 7.2% over the prior year. Sales topped $306 million, up 6%, and a strong operating margin of 24%, up 2.5 percentage points, led to a 19% gain in pre-tax earnings to $74 million. As profitable as See's was, the business faced few growth prospects. Speaking at the annual meeting the following year, Buffett noted how See's, and candy in general, really wasn't that portable. See's found ways to increase its physical volume slightly, but there weren't huge opportunities for growth like other businesses. For some reason, candy didn't travel well. Soda and shaving blades did, but See's couldn't just open a store in faraway state and expect to have the same results. It was tried more than once. Berkshire's jewelry operations increased pre-tax earnings by 31% to $51 million, as costs at Helzberg were brought under control. Scott Fetzer's earnings increased 7% to $147 million. The aviation services segment, comprised of flight safety and executive jet, collectively earned $225 million in 1999, up 24% from the year before. Part of the increase in earnings was because Executive Jet was acquired in August 1998, so it wasn't a true comparison. The other factor was the ability of the businesses, particularly flight safety, to invest in profitable growth. Flight safety was a capital-intensive business but had a high operating margin that translated into satisfactory returns on capital. Its pre-tax return on capital was consistently in the mid-20% range prior to Berkshire's acquiring it. Each flight simulator required up to $15 million capital investment and could only be used by one person at a time. Together, Flight Safety and Executive Jet spent $323 million on capital expenditures in 1999, compared to depreciation of just $77 million. The sky was the limit for these two Berkshire subsidiaries. Investments. Berkshire's equity portfolio returned low single digits against the backdrop of the S&P 500, marching forward 21% during the year. Another way to view this performance is via look-through earnings. We can make an approximation based on the $464 million in dividends reported by the insurance group. This probably represented the bulk of dividends Berkshire earned, as most of its marketable securities were held in the insurance subsidiaries. On top of that, Berkshire's major investees had look-through earnings of $707 million. Together, this amounted to $1.2 billion, or 3% of the average portfolio value. Berkshire's bond portfolio also contributed to the lackluster performance of its investment portfolio. At year-end 1999, unrealized losses on the $30 billion bond portfolio had grown by $1.1 billion. A sharp rise in interest rates was the culprit. The 10-year Treasury increased from 4.7% to 6.5% from December 1998 to December 1999. Fortune magazine article. Included with the 1999 annual report was an article Buffett penned for Fortune magazine in November 1999. In it, he laid out his case for why the market was setting itself up for disappointment. While not predicting an immediate decline, Buffett hinted toward the market being overvalued. He cited a survey of investors at that time who expected annualized returns of over 22% for lower experienced investors and as high as almost 13% for more experienced ones who had more insight into markets. He said both were probably too optimistic. To make his point, Buffett used what he always did: logic. Looking at the Fortune 500 overall, the companies earned $334 billion in 1998. The market value of those same 500 companies as of early 1999 was about $10 trillion. This meant that if one hypothetically owned the entirety of those companies, they would be earning a return of something like 3.3% pre-tax. And this wasn't counting the frictional costs of moving in and out of stocks as investors did, which Buffett estimated to be about $100 billion a year. In early 1999, the 10-year U.S. Treasury note yielded between 1 and 2 percentage points higher than that 3.3%. Why would investors rationally own a group of risky companies when they could buy a risk-free government security? Likely because investors thought stocks would keep going up as they had in the past. A more rationally sounding, though not entirely rational, argument was the belief that either interest rates would decline or corporate profits would increase. Only under those two circumstances would the stock valuations in 1999 make sense. Buffett believed many company valuations were out of touch with reality. He discussed valuations at the 2000 annual meeting, traveling back in time to make his point. The first investment primer that I know of, and it was pretty good advice, was delivered in about 600 BC by Aesop. And Aesop, you'll remember, said, "A bird in the hand is worth two in the bush." He meant that investing involves deciding based on the projected value of a business in the future. Value in this case is calculated by estimating how many birds, how much cash, are in the bush. The value of that cash is further based on when it emerges and the interest rate at that time. Some companies were valued by the market as high as $500 billion, yet produced very little actual earnings. If such a company wasn't going to pay an owner $50 billion that year, assuming a 10% required rate of return, then it had to pay out that much more the next year. Assuming no payment in year one, a $55 billion payout in perpetuity was required starting the following year. Wait another year and that annual payout rose to $60.5 billion, and so on to justify the 10% of return. Recalling Aesop again, Buffett said that every year one waited to take out a bird, cash, and that many more birds, cash, were required in the future. And how certain are you there are that many birds available to take? This short lesson was important because it explained the rationale behind preferring companies earning cash today. Since the longer one waited, it became that much more important to grow the future stream of cash. It also highlighted the importance of certainty. If you weren't going to get cash immediately, how much worse was it that the future cash flows were uncertain because of the risk to changing business economics? Lastly, the preceding example using a hypothetical $500 billion market cap company would have been the rare elephant, given the requirement to earn something like $80 billion a year pre-tax to get that $50 billion after tax. Since such companies didn't then exist, and even now in 2020 are rare, valuations were clearly incorporating some unrealistic expectations. As painful as 1990 was from a business perspective, with book value up just 0.5 percentage point, Berkshire Hathaway's stock price also took a big hit. Shares traded between a low of $52,000 and a high of $81,100. Considering Berkshire ended the year with $47,000 of per-share investments, the market was almost entirely discounting Berkshire's significant operating businesses. Even though operating earnings fell, Berkshire remained a wonderful, growing collection of businesses. Its long-term growth in per-share book value over the preceding 35 years that Buffett had been in control remained an astounding 24% compounded annually. Year 2000 issue. The big worry as the calendar turned to the new millennium was the so-called Year 2000 issue, or Y2K. The problem lay with computers and their ability to handle the turn of the millennium with respect to dates. No one knew if, for example, January 1st, 2000 would register as January 1st, 1900. Such a mistake could cause havoc with systems as calculations would be 100 years off, spelling disaster for timing and payment systems, for one. Berkshire incurred roughly $60 million in costs, not all in 1999, getting ready for the date change. Even though everyone knew the year was coming, some, including governments, were far behind in their preparations and testing. In the end, it was all hype. Berkshire entered the new century and the new millennium with old-world businesses in hand and a readiness to acquire more. Chapter 9. 2000 to 2002. 2000. At the turn of the millennium, Berkshire's two capital allocators faced unrelenting pressure to change their ways. With internet mania fueling the dot-com boom, Berkshire was decidedly old world and proud of it. Experienced managers Warren Buffett and Charlie Munger, now both in their 70s, stayed within their circle of competence. They and Berkshire shareholders were rewarded for this patience. The year 2000 brought some exciting acquisitions, along with some spots of trouble. Checkbook in hand, Berkshire went on a spending spree. It paid close to $8 billion for 8 acquisitions, completing 2 agreed to in 1999, Mid-American and Court, discussed below, and arranging another 6. To make things better, almost 97% of the amount spent was in cash, and Berkshire incurred no debt in the process. Despite this frenzy of acquisition activity, Berkshire remained flush with investable funds and ready for more and larger acquisitions. Finding 8 new operating subsidiaries to acquire in just over a year was most assuredly cause for a change in Buffett's self-graded D from 1999, though not the A star people would flaunt to parents. Buffett characterized 2000 as only decent due to some struggles in its existing businesses. Geico had their rare off year, weaknesses remained at General Re, and Dexter struggled mightily against foreign competition. To make matters worse, Buffett thought Berkshire's equities portfolio was fully priced, meaning its value would likely not rise beyond underlying gains in intrinsic business value. Acquisitions. Our acquisition technique at Berkshire is simplicity itself. We answer the phone, Buffett wrote to shareholders. He wasn't kidding. Buffett and Munger had long talked about their strategy of not having a strategy, and the year of 2000 was proof it was working. Like business results in general, acquisitions were necessarily lumpy and could not be anticipated or rushed along. Did Berkshire's capital allocators cave and purchase some fallen internet companies? Quite the opposite. Buffett reported that Berkshire had embraced the 21st century by entering such cutting-edge industries as brick, carpet, insulation, and paint. Try to control your excitement. Though these businesses were the very antithesis of internet companies, the dot-com boom and subsequent bust did play a role in Berkshire's acquiring them. 2 factors led to this flurry of acquisition activity. One was the prospect of a near-term economic slowdown. Other people were reluctant to commit in the face of uncertainty. Berkshire was buying to keep and had its eye on the horizon. The second factor was that Berkshire paid with cash and analyzed businesses on an all-equity basis. Other purchasers relied on financing from the junk bond market, which had dried up. Number 1. Mid-American Energy. Acquisition date, March 14, 2000. Description: provider of electric service in the Midwest U.S. and the United Kingdom. Purchase price, $1.24 billion for 76% of the company. Mid-American was more than an energy business. It was a conglomeration of numerous energy subsidiaries. Like its new conglomerate parent, Mid-American had a long history and decentralized operations. Mid-America's lineage is too long to discuss here, but its history just prior to joining Berkshire is worth mentioning. Mid-American Energy Holdings Company was the result of the 1998 acquisition of a company of the same name by Cal Energy, an Omaha-based utility company. The new company was renamed Mid-America Energy Holdings Company and reincorporated in Iowa. Mid-American's chairman and CEO David Sokol and his right-hand man, President Gregory Abel, along with investor and board member Walter Scott Jr., used this base to acquire other energy assets. The Mid-American deal came about via Walter Scott Jr., who also sat on Berkshire's board of directors. Mid-American's talented and entrepreneurial management team impressed Buffett, and he thought investing in Mid-American might make sense at the right price. Buffett was cited in a press release saying, "We buy good companies with outstanding management and good growth potential at a fair price, and we're willing to wait longer than some investors for that potential to be realized. This investment is right in our sweet spot." Buffett did not detail his exact thought process in determining the attractiveness of the Mid-American investment, but there are a few factors that likely weighed into his decision. History as a low-cost operator. In addition to achieving the highest returns available under regulatory frameworks, the low-cost operator could protect and reinforce its competitive position by keeping rates low for its customers. This in turn could gain favor from regulators, allowing additional investment. Deregulation. This opened certain markets to allow customers to buy energy from the producer of their choice. A low-cost operator would have additional opportunities for expansion, aided by its ability to improve the assets it acquired. A strong balance sheet. Mid-America's investment-grade credit rating allowed it to lower its cost of debt and thereby improve its ability to keep costs low for customers. It was a virtuous cycle. Even with the prospect of wider deregulation, Mid-American remained an operator in regulated markets, most notably in the Midwest United States. During 1999, 66% of Mid-America's revenues were generated in regulated electric markets, 25% from regulated gas, and 9% from non-regulated businesses. Energy companies within the regulated markets enjoyed protected returns on capital that were typically in the low double-digit area. For example, Mid-America's Iowa operations were allowed a 12% return on equity. The downside of a regulated return was offset by the ability to invest in large sums of capital. Mid-America offered Berkshire Hathaway a place to direct the substantial excess earnings from its other businesses into